going to discuss the role of relevant cost analysis for decision-making process. Relevant cost analysis is a decision-making technique used in businesses to determine true cost difference between alternatives. It is also called incremental, marginal, or differential analysis. Analysis models include only relevant costs that differs between alternatives being considered, and these costs are typically broken into variable and fixed costs. In order for a cost to be relevant, it must be future, cash flow, and incremental. Relevant costs take place in the future. Past or sunk costs are considered non-relevant. Relevant cost is a cash cost. Non-cash cost, such as depreciation or amortization expense, is non-relevant cost. Relevant cost is also incremental because they are only incurred when an activity of relevance has been initiated or increased. It is often important for businesses to differentiate between relevant and irrelevant costs when analyzing alternatives, because considering non-relevant costs can lead to unsound business decisions. In addition, ignoring irrelevant costs in analysis can save time and effort. Relevant cost analysis considers only relevant costs in decision-making process. Relevant costs include prospective incremental costs and opportunity costs. Prospective incremental costs are future costs that only incurred when an activity of relevance has been initiated or increased. And opportunity cost is a missed opportunity when choosing one alternative over another. Both prospective incremental cost and opportunity cost are considered relevant and should be considered in decision-making process. Relevant cost analysis ignores non-relevant cost. Non-relevant costs include sunk cost and non-cash cost. Sunk costs are past costs, already incurred and can't be recovered. It is a sum paid in the past that is no longer relevant for decision making about the future, because the sunk cost will remain regardless of any decision being made. These costs are not included in relevant cost analysis. Non-cash costs such as depreciation and amortization expense is also considered non-relevant costs. Depreciation expense is recognized in the business records for accounting purposes. It is about dividing the historical cost of fixed asset over its useful life in order to recognize the decline in the value of the asset over time. So it is artificial cost. It is not a real cost. It does not represent cash outflow. That's why it is considered irrelevant in the context of decision-making process. In this chapter, we will explain the application of relevant cost analysis to specific decision problems. In specific, we will consider 5 decisions: setting prices of products, accepting or rejecting special orders, adding or eliminating products, segments, or customers, processing or selling joint products, and finally deciding whether to make products or buy them. Make or buy decision. When applying differential analysis to pricing decisions, each possible price for a given product represents an alternative course of action. The sales revenue for each alternative and the cost that differs between alternatives are the relevant amounts in these decisions. Total fixed costs often remain the same between pricing alternatives, and that's why it should be ignored. It is considered irrelevant in the context of making pricing decisions. In selecting a price for a product, the goal is to maximize net income. The goal is to select the price at which total revenues exceed total costs. Total future revenues exceed total future costs by the greatest amount, thus maximizing net income. A high price is not necessarily the best option. A high price is not necessarily the price that maximizes net income. If a company set a high price, the demand level may decrease as customers switch to lower priced competitive product. So in the pricing decisions, management should seek the combination of price and volume that produces the largest total contribution margin. Expected sales volume should be considered when making pricing decisions, along with the contribution margin per unit. ABC company estimates product demand to be 15,000 units at $6 selling price per unit, 12,000 units at $7 selling price per unit, 10,000 units at $8 selling price per unit, and 7,000 units at $9 selling price per unit. Fixed cost of $20,000 per year are not affected by the difference in the demand level. Variable cost is $5 per unit. The question that we need to answer is, what price should be set for the product? $6, $7, $8, or $9? So selling price per unit and sales volume are the relevant amounts for pricing decisions. We have four options, either to sell the product at $6, $7, $8, or $9. Variable cost per unit will be the same under each option. It will be $5. Contribution margin per unit is the difference between selling price per unit and variable cost per unit. It will be different under each option. It will be either $1, $2, $3, or $4. The demand level will be different under each selling price. When the selling price is $6, the demand level is 15,000 units. When the selling price per unit increases to $7, the demand level decreases to 12,000 units. When the selling price per unit increases to $8, the demand level declines to 10,000 units, and when the selling price per unit increases to $9, the demand level further declines to 7,000 units. By multiplying contribution margin per unit by the expected sales volume, we can obtain total contribution margin. Total contribution margin will be different under each option, and it is the highest when the selling price per unit is $8. When the selling price per unit is $8, the contribution margin per unit is $3. The demand level is 10,000 units, and the total contribution margin is $30,000. This amount contributes to recovery of fixed cost. $20,000 fixed cost will be the same under each option. It doesn't differ between alternatives. And the remaining amount is net income. So $30,000 total contribution margin contributes to covering $20,000 fixed cost, and the remaining amount is $10,000 net income. So the company should select the price of $8 per unit because this price generates the greatest total contribution margin and net income. So the highest price is not the best option. We need to consider the demand level under each price. We need to choose the combination of selling price and sales volume that generates the highest contribution margin and net income. And this is true for the third option when the selling price is $8 per unit. Relevant cost analysis can also be implemented to make decisions regarding accepting or rejecting special orders. Relevant cost analysis can determine whether companies should sell their product at prices below regular levels or even below unit cost. When operating at less than full capacity, management should seek additional business. Such additional business may be special orders at a discount. Management may decide to accept a special order at prices lower than regular levels or even lower than average unit cost if the differential revenues from the additional business exceeds the differential costs. A Braves company produces and sells a single product with a variable cost of $8 per unit. Fixed cost is $48,000. The selling price is $20 per unit, and the company expects to produce and sell 5,000 units. That's why the expected net income is $12,000. The company receives an order from a foreign distributor for 3,000 units at $10 selling price per unit. This $10 selling price per unit is a discount price. It is not only half of the regular selling price per unit, $20 regular selling price per unit, but also less than the average cost per unit. The average cost per unit is $17.6. However, the $10 price offered exceeds the variable cost by $2. The contribution margin per unit for the special order is $2 per product unit. If the company accepts the order, net income increases to $18,000. In specific, if the company accepts the order, revenues will increase to $130,000. Net revenues will increase by $30,000 in effect. 3,000 units multiplied by $10 selling price per unit. Variable cost will also increase by 60%. Sales volume has increased by 60%. That's why variable cost should also increase by 60%. Variable cost will increase to $64,000. Total fixed cost don't exceed with the special order. It will remain the same. It will be $48,000. It will not be affected. At the end of the day, net income will increase to $18,000. So revenues will increase from $100,000 to $130,000 if the special order of 3,000 units at $10 discount price is accepted. If the special order is accepted, revenues will increase by $30,000. Variable cost will also increase from $40,000 to $64,000. Variable cost will increase by $24,000 because sales volume increases by 60%. Variable cost also increases by the same proportion. Contribution margin will increase from $60,000 to $66,000. So contribution margin will increase by $60,000 if the special order is accepted. Fixed cost will remain the same under the two options. If the special order is accepted or rejected, fixed cost will be $48,000. That's why fixed cost is not incremental cost. It is irrelevant cost in this case. Net income accordingly will increase from $12,000 to $18,000. Net income will increase by $6,000 if the special order is accepted. So the net benefit of accepting the order is $6,000. That's why the special order should be accepted. Relevant cost analysis is also useful with respect to making decisions related to adding or eliminating product, segment, or customer. Periodically, management has to decide whether to add or eliminate certain products, segments, or customers. Relevant cost analysis is useful in this decision making because income statement of the company does not classify costs with certain products, segments, or customers. Thus, companies need to reclassify costs as those that the action would change and those that it would not change. If companies add or eliminate products, they usually increase or decrease variable cost. Fixed cost may not change. Management base decisions to add or eliminate products only on the differential items, that is, the costs and revenues that change. Bookstore is considering eliminating its art supplies department. The department is generating $100,000 annually. $80,000 variable cost is assigned to the department and $30,000 fixed cost is assigned to the art supplies department. So cost incurred is higher than revenues generated by $10,000. The department is making losses of $10,000. Should the bookstore eliminate the art supplies department? So if the art supplies department is closed, the business will lose $100,000 revenues. The reduction in cost would be only $80,000 variable cost directly related to the art supplies department, and the $30,000 fixed cost are general bookstore fixed cost allocated to the department. These fixed costs would continue to be incurred and wouldn't be saved by closing the art supplies department. So the art supplies department has been contributing $20,000 annually towards covering the fixed cost of the business. Consequently, the elimination could be a costly mistake unless there is a more profitable use for the vacated facilities. So the net benefit of keeping art supplies department is $20,000, and the decision should be not to eliminate the art supplies department because it contributes $20,000 towards covering the fixed cost of the business. So today we have explained the application of relevant cost analysis to specific decision problems, setting prices of products, accepting or rejecting special orders, adding or eliminating products, segments, or customers. The next time, inshallah, we will complete this chapter. We will explain the application of relevant cost analysis to processing or selling joint products decisions and make or buy decisions. Thank you.